Welcome to the Lender's Guide on Helping Real Estate Agents Succeed by Saeed the Lender. I've been getting a lot of questions from my referral partners on how to best communicate with their new home buyers, especially first-time home buyers. So I thought I'd put this together for you for your own personal use or to share with colleagues, peers, somebody who's new in the industry. I think this is going to be very helpful for you to close more deals, have more confidence when you're out there speaking with first-time home buyers out on your consultations or during open houses. So what you're going to learn today is some of the common questions that you'll get asked out there when speaking with new home buyers. So let's get right into it. Here's why it matters. So agents often get questions about financing that they're not equipped to answer confidently. So this module gives you the foundation you'll need to avoid losing clients due to misinformation and or uncertainty. So module 1, lending basics every agent should know. How loan types impact your buyer's budget. So your client is going to potentially qualify for multiple different types of loan programs. And really what it comes down to is them speaking with a mortgage lender and having that mortgage lender figure out exactly where they're going to fit in. Sometimes borrowers aren't going to have the greatest credit. Sometimes borrowers are veterans. Sometimes borrowers are looking at homes in rural areas. So there's going to be different loan types for different scenarios. FHA is going to be for first-time home buyers without the best credit, not a whole lot of down payment. VA obviously for veterans, USDA for rural areas. And then conventional, people with great credit have a strong down payment. What is a pre-approval versus a pre-qualification? So a pre-qualification is simply you contact your lender and you say, hey, I have somebody who want to connect with you. That lender connects with that particular buyer, and the lender asks a series of questions, and based on that conversation, if the lender is confident that they can get an approval, they're going to say, hey, I think you pre-qualify. Time to start a loan application to get a pre-approval done. Pre-approval is one step further. That's when we, as a lender, collect documents such as W-2s, pay stubs, bank statements, copy of their ID, and we make sure all that checks out. If everything checks out, then we can send out a pre-approval letter. That's where they can start shopping and making offers on homes. So you want to keep that in mind. Pre-qualification, pre-approval, completely different things. Common mistakes that can actually kill a deal. So big purchases. Once someone's pre-approved, any big purchases that someone makes on their credit cards, or if they finance a car, for example, or they make a loan to somebody, or they get a loan from somebody and there's a payment associated with that, that could increase their debt-to-income ratio, which could make them disqualified, because lenders look at what's called the debt-to-income ratio. We take all of their payments on their credit report, add all those together, divide that by their gross monthly income. And a lot of times, home buyers want to look at homes or make offers on homes at the highest debt-to-income ratio limit. And if a lender is giving your borrower a pre-approval based on the max debt-to-income ratio limit, and they go out and buy a car or buy furniture on credit, any additional payment to their credit could put them out of qualification. So they could be at a 48% debt-to-income ratio. Let's say the max is 50, and them buying a new car gets them a new payment of $300-400. That would automatically disqualify them unless they're able to pay off credit cards to bring that debt-to-income ratio down, or pay something off to get that debt-to-income ratio down. The only way that we'd be able to remedy that too, if they can't pay it off, is adding a co-borrower or co-signer to get more income to bring that debt-to-income ratio limit down. But keep in mind that debt-to-income ratio is also taking into account that co-borrower or co-signer's liabilities on their credit report. So make sure you equip your buyers not to go out and buy new furniture before they close on the house. Why it matters. Today, buyers are highly sensitive to rates, so knowing how to counter the hesitations to keep deals moving forward. So this is about overcoming objections about interest rates. So, rates have been higher for longer. We all know that. And how we get around that and how we come over those objections is going to be very important when you're getting these deals to the finish line. So A big one is I'm going to wait for rates to drop. How are you going to respond to that? Well, as a real estate agent, you're the expert. You're the one out there in the field. You see homes on the market for how long, however long they are. Some homes are going quicker than others, depending on what market you're in. But you can just tell by the people out there making offers on homes and putting cash offers or putting over asking to win the home. You are seeing people out there wanting the asset. They want the hard asset so that they can build equity, keep their payment the same, because a lot of people are complaining about higher rent, higher HOA dues. If they're living in a condo, they want to move to a house, for example. So a big one though is just, if you wait for the prices to drop in homes or the interest rates to drop in homes, you could definitely wait. Is that the correct strategy? Maybe. We don't know exactly what's going to happen in the future. What I can tell you though is if rates do come down faster than we expect, you're going to see everybody that's on the sidelines come back into the market and bid on the same low inventory homes that are available out there right now. Which, as you know, as a real estate agent, you have to confidently be able to tell your buyers, look, if you wait for rates to come down, you're going to be competing with other buyers just like you who are waiting. And by that, you're going to see people gunning for the same property that you're looking for. You see this house now at $500,000. If you wait a year, for example, or 6 months, rates come down to a level that you're comfortable with, everyone else is going to have that same comfortability. They're going to bid on the same house, and that $500,000 house that you're looking to buy right now today is potentially going to go over asking to $520, $530, $550, maybe even $600, if not higher. So your payment on that new updated price at that time is likely going to still be higher, even with the lower rate, than if you were to buy now with a slightly higher rate. Whereas if you just bought today, you can start gaining equity up until that point and then refinance up until that point. So the idea is to build equity, lock in the actual asset before the flood of people come back in, because not only are you going to have an asset, you're going to have an appreciating asset. So that's a great way to explain that I'll wait conversation to your buyers. And then another great one is explaining temporary interest rate buydowns versus permanent interest rate buydowns. So as you know, you're going to have an interest rate when you get a mortgage. You have the ability as a home buyer to yourself pay what are called discount points. Discount points are prepaid interest that you pay up front for a lower interest rate. Now you can get these discount points paid for by your own funds, or you can get a seller credit or a lender credit from whoever you're using. So for example, if you are a home buyer and you go to a builder and they're offering $10,000 in seller credits, you can use that to buy the rate down. Or if you're buying a house that's been on the market for 30 days, the seller is willing to give you $15,000 in seller credits as a buyer. You can use that $15,000 not only for just a permanent buy down, but alternatively you can go with a temporary interest rate buy down, where a temporary interest rate buy down, we as the lender will qualify the buyer on the actual rate. So let's say they get approved for 6.875. Well, if they get a seller credit from the seller, we can apply a loan feature known as the 2-1 buy down, which is going to differ in cost based on the down payment and the interest rate that the buyer gets qualified for. But let's say that $15,000 does cover a 2-1 buy down. That buyer now is going to have not a 6.875 starting out. They're getting qualified on the 6.875, but their starting rate is going to be 2% lower on that first year. The second year, it's going to be 1% lower. That third year, it's going to go back to the original rate that they got qualified for, the 6.875, but you got to explain at that time, you're likely going to be able to refinance lower than that second year or even that first year interest rate payment. So it's a great way to stair-step your way into your payment while not having to come out of pocket for that lower payment right off the bat. So it's a great tool, great strategy, and it's a great way to get over, I just want to wait until rates come down. So helping buyers understand monthly payments beyond just rate. So you also want to make sure when buyers are asking about, what the payment would be, a lot of the calculators are out there are going to estimate taxes and insurance, and a lot of them don't include HOA or mortgage insurance. So depending on what lender you use, a buyer, or even what program you use, a buyer is going to always have the principal and interest payment, right? And then the taxes, that's just going to be what the taxes of the home are. You can look that up pretty easily on the county. So principal, interest, taxes, and insurance. So insurance, that's also going to be variable, but you want to estimate a little bit over than typically what is showing, or what you want to estimate less than what's typically showing on those Zillow calculators, because those Zillow calculators put like $225. Really, it's like about $125 or less. Condos, way less as well. And then private mortgage insurance. So every lender is going to have different rates on their private mortgage insurance. Also depends on the credit score of the buyer. So if the buyer has great credit, mortgage insurance might be a little bit lower. If they're putting 20% down, again, they're not going to have any mortgage insurance. But if they're putting a higher down payment, mortgage insurance might be lower. Additionally, if you use a broker like myself, we use specific lenders that discount mortgage insurance for buyers who have great credit and maybe not be putting 20% down or even 15 or 10. There's still going to be discounts that they can get on their mortgage insurance if they use particular lenders out there. And then of course, HOA. You want to make sure that you let them know this property has HOA. So if it's a condo, you got to factor in the HOA. If it's a detached condo, it could have HOA on there, right? So make sure that you're telling your buyers there's more to the payment than just the principal and interest payment, right? So we want to make sure that they're comfortable with that overall payment. So on the call, when I'm talking with your buyers, I'm saying, hey, what is your max monthly mortgage payment all in, including taxes, insurance, HOA, mortgage insurance? What is that number? That way we can actually derive a purchase price, set a down payment that makes sense for your goals as you say they are, right? So keep that in mind. Module 3, closing cost hacks that give your buyers an advantage. So many buyers don't actually realize that they can reduce their upfront costs by leveraging the seller, negotiating with the seller, right? As a real estate agent, you are a master negotiator. You know what you can ask for, what you can't ask for based on the competitiveness of that property, right? So you're going to want to educate your buyer and let them know, I'm sure you already do this, hey, if we go in, asking for too much because there's other offers, we may not get this house. Just letting you know. So let them make that decision for themselves, and you position yourself as the expert and making sure that you have their best interest, but also, you make it, you give them the right expectations of, how much you can actually get the seller to cover. Now, if you know the house does have some defects, maybe there's going to be an inspection, that is something that you can keep in your back pocket and let your buyers know and say, hey, this house doesn't have a whole lot of competition. I don't think the seller is going to want to give you seller credits, FYI, just because they want to net a certain amount. But what we can do is maybe make the offer at full price, do the inspection. That inspection comes back. There are some things that need to be done to the house. That's when where we can negotiate with the seller. And, it's up to the seller if they want to accept or not. But that's one way also that we can minimize the closing costs that are going to be associated with the loan. Closing costs are typically around 2 to 3% of the loan amount as well. So just keep that in mind. So seller concessions, how to use them, when to use them. Again, negotiation up front. You want to be leveraging seller credits when you maybe see a house that's been on the market longer than 30 days. Maybe you've seen some price cuts. I like when you see price cuts, and I educate my real estate agents. If you're going to be asking the seller for additional closing costs, maybe you do go in at that full price offer and ask for those seller credits up front. But again, the seller is going to net, however much less than the seller credits, right? So if you're offering full price offer and you've seen a price cut of $15,000 and you're going in at that full price and asking for $15,000, that's $30,000 to the seller that they're missing out on, right? So the seller may go, you know, we just did a price cut. I don't want to give you that 15,000 additional on top of that price cut. So we're just going to increase the purchase price by 15,000 and we'll give your buyer the credits, right? So, you know, having a lender work alongside you and sharing with your buyer what the increase in purchase price along with the seller credits can do for their payment is essential and vital to get these deals done. Because a lot of times, even at the higher price point with the seller credits for the temporary buy down or permanent rate buy down, it's still less of a payment than if they got the lower purchase price, right? So it sometimes to buyers it just doesn't make sense. Like, well, I'm paying more for the house. How is the payment lower? Because that $15,000 of credits is going towards a buy down, which is going to make their payment so much more less than it would have been at that lower purchase price with no buy down. So lender credits versus seller credits, what's the difference? So a seller credit is what we just talked about. A lender credit is exchanging a higher rate for a credit. So let's say we get somebody approved at 6.5% with no discount points, meaning the buyer is not paying any points to get that 6.5 rate. But as a lender, we could go up in rate to, let's say, 7% and give the lender credit to the buyer to cover those closing costs. So yes, the buyer is going to have a slightly higher interest rate, but they're going to be saving on the upfront costs through those credits. Can I roll closing costs into my loan? What to tell the buyers? Absolutely, you can roll those in with a credit, right? It's not just right off the bat, you don't have any closing costs. You're always going to have closing costs. Even on VA loans, you're going to have closing costs. Yes, it's zero down payment on a VA loan, but there are closing costs that the VA buyer will have to come up with, which can be rolled into the loan if you get a seller credit. So you find a $500,000 house and you need $12,000 of closing costs. The buyer needs to come in with $12,000. You can ask that seller, hey, we need $12,000 off the price with the seller credit. They may go, no, we want to do $512 to cover our net proceeds. We'll still give you the seller credits of $12,000 to cover those costs. So that is rolling in the closing costs on loans. Preparing buyers for a smooth loan process. So many deals fall apart because buyers don't know how to avoid common financing pitfalls. A big one is, again, financing things while in process, while in underwriting. You don't want to be financing anything while in processing or in underwriting. You don't want to be changing jobs when you're in underwriting. You don't want to be changing the type of income that you're making. You don't want to change anything to do with your business while you're in underwriting. Just leave everything the same once you get pre-approved and into processing and underwriting, because anything can really affect your chances of getting approved. So that's just a big one. Don't change anything. Why does my client keep asking for more docs? Why does my client keep getting asked for more docs? So as a lender, we're lending out hundreds of thousands of dollars to your buyers, right? And as a real estate agent, it's important to really back up your lender during this process, because any good lender is going to ask for the preliminary documents to pre-approve them. But once we get into underwriting, not only do they look at what we've collected, but they recollect new documents so that they're up to date. Things like updated pay stubs, bank statements, W-2s, whatever it is. We lenders can only go so far, at least loan officers can go so far before an underwriter is going to scrutinize and look at all the documents that we pre-qualified and pre-approved them on. So it's not really up to us as the loan officer to say, this is going to fly. It's really, at the end of the day, we're at the mercy of the underwriter. So a good lender is going to get everything that the underwriter is going to ask for up front so we can minimize the paperwork. But some borrowers have different situations, different ways of making income. So a lot of underwriters, they just want to dig a little deeper and make sure that the income and the quality of the loan file is sufficient to be able to be sold to the secondary market, which we're not going to go into. But Again, I already talked about this, do's and don'ts after getting pre-approved. Don't sabotage your own deal by telling them to go buy furniture or opening up credit cards or changing loans or changing jobs. So you want to make sure you keep that front and top of mind for your buyers so that they're not out there making bad decisions and shooting themselves in the foot. Self-employed, 1099, or commission buyers, what's the difference? So we can definitely get people who are 1099 or commission folks who are, those types of income. We can get those people pre-approved. But if, for example, we have a pre-approved buyer on a W-2 income, let's say, they're getting paid hourly or salary, and then they decide to go change their type of income during the process of getting a home loan to 1099 or commission. That's a big no-no. We don't want the type of income to change during the process. If they are W-2 and they go to 1099 and it's in the same industry, sometimes we can make it work. If they're going from 1099 or commission to W-2 full-time, that's okay. Well, they like to see W-2. They like to see consistency. They like to see something that is going to be somewhat permanent, right? A lot of times we can get people pre-approved just on letters from the employer stating their salary that's going to be coming up on their new job, for example. So those are big ones. We don't want to be changing the types of income and how we make that income when you're under contract or going through the underwriting process. So Module 5, how to talk to first-time homebuyers about lending. So first-time buyers have a lot of fears. Knowing how to educate them helps build trust and close more deals. You don't need 20% down. If you're on Instagram or on TikTok, you've probably seen all the influencers, all the lenders, all the real estate agents talking about this. The minimum that you need on a conventional loan, if you're a first-time homebuyer, is 3%. That's it, 3%. FHA, 3.5%. VA, 0%. USDA, 0%. These are all big myths out there that people still believe and still think they need 20% down. The only reason you would need 20% down is to get rid of mortgage insurance. But again, if you don't have 20% and people are like, I don't want to have to pay mortgage insurance, let them know. You have a lender, you have a mortgage broker, me. They can get them discounted mortgage insurance, which an extra $80 or $90, $100 on their mortgage payment is nothing when they have so much more to gain by getting the hard asset, getting the property, keeping their mortgage payment the same, not having rent go up. Those are all big talking points that you tell your buyers, look, mortgage insurance ain't that bad, and if you go with a conventional loan, it's going to drop off anyway. Oh, by the way, most home buyers don't keep their mortgage for more than 7 years. 5 to 7 years is when they typically sell or refinance. So if you've been in your house for 5 years, it's gone up in equity, and you refinance, you may be able to just get rid of that mortgage insurance right off the bat when you refinance into a lower rate. So, it's a win-win all around if they just get the asset in the first place and not wait. Is my credit good enough? How to help buyers understand credit scores. So minimum credit scores on an FHA loan, 580. Okay? 580 is what they need if they have crappy credit. 580 is what they can get approved with going with an FHA loan. You can go down to as low as 500 on an FHA loan, but you need 10% down. A lot of people don't have 10% down, especially if they're going with an FHA loan. So 580, 620 is what you want to shoot for. So that opens up more loan options. And let them know too, the higher your credit, the better interest rates that are going to be available to you, the better rates on mortgage insurance are going to be available to you. But just put people at ease. You don't need stellar credit to get a mortgage. I have student loans. What you need to know about that? Well, if you have student loans, just know you still can get a mortgage. If you go with an FHA or conventional, they're going to calculate the payment on those student loans. A lot of student loans have zero monthly payment requirements on their credit report. So what we do as lenders, we take a percentage of their full student loan balance and we count it against their debt to income ratio. Easy. FHA is 0.5% of their full balance. Conventional is 1% of their full balance. So as long as they qualify outside of that, we're typically going to be fine to move forward just as normal. Module 6, helping buyers compete in a tight market. So in a competitive market, agents who understand creative financing options can help their buyers win deals. So This is big. Again, if we're asking for credits, you may want to, go over asking on the property to get those credits. That way, again, you're giving the sellers what they want in terms of net proceeds. If you know that it's in a competitive situation, you may want to go a little bit higher and still ask for those credits, because even with the credits after the seller gives those to the buyer, they're still going to be netting more than what they have as a offer price or a list price, right? So you want to make sure that you tell your buyers, look, if we ask for too much or we lowball, we probably aren't going to get this offer. You can also explain to your buyers, hey, look, if we get your pre-approval dialed in with your lender, we get a great pre-approval letter. Your lender looks over everything, maybe sends the income into underwriting, make sure it's fully underwritten or at least automated underwriting. We can ask for a short close. So 21 days or sooner, we can ask the lender if they can do that, and let your buyers know if we can put in an offer with 21 days, which is shorter than 30 days, to a seller, they're like, heck yeah, I'm going to get my money faster. So keeping that in mind is huge. Another one is if, let's say the buyer's like, I have 20% down plus my closing costs, but I really want that 2-1 buy down. Well, you can tell them, say, hey, look, speak with your lender, see if maybe putting 15% down instead of 20, what your mortgage insurance would be. Use that 5% for the buy down to get that lower rate that you want, and we can still be competitive. So a lot of different ways that you can really explain to your buyers how to win the home in a competitive market. How much over asking should I offer? Helping buyers strategize. We talked about that, but a good one is talking about escalation clauses, appraisal gaps, lender options, and bridge gaps. So this happens quite a bit if you're really competitive on a home, or the home is very competitive. Yeah, maybe there is 5 people bidding on the same house, and your escalation clause goes up to $550. You get the contract, but the home appraises for $540. That buyer is going to have to come up with that $10,000 difference, right? So if they have 20% down, what I will do as a lender is just say, hey, maybe we reduce your down payment to cover the appraisal gap. That way you can still get the home. So it's an easy conversation to bridge those gaps, bridge those appraisal gaps. And as a lender as well, what I do is I give options based on the escalation clause highest amount. So if your escalation is up to $550, I'm going to make sure that they know what the payment is going to be at $550, so they're comfortable moving forward, right? The power of fully underwritten pre-approval. So this is beyond a pre-qualification, beyond a pre-approval. This is a underwritten pre-approval. This means that the lender takes the file to the underwriter, gets the stamp of approval, so that once we get under contract, really the only thing is insurance and appraisal is what we need to move the loan quicker through underwriting. So it's a great strategy to be more competitive as well. And this is something that I tell buyers, like, look, if we want the best chances of winning the house, let's get you pre-approved, get your documents over to me so I can double check this and triple check it with an underwriter. Should buyers waive financing contingencies? So you, as the real estate agent, you're going to be the expert in this conversation. Obviously, if you do waive financing and they lose their job, there's nothing really we can do besides get a co-borrower or co-signer, whatever it is. But with an underwritten pre-approval letter, a lot of times buyers will opt to waive financing because they know they have the finances, they know they have the solid job. They're not worried about any of that. So in an effort to being the most competitive, some buyers will decide to do that. And it's your job as a real estate agent, my job as a lender, to let them know, hey, this is what could happen. And, this is what we've done to ensure that you're going to get these funds as your loan officer or as your lender, right? So Module 7, how to win more listings with lending strategies. So why it matters. Most agents focus on buyers. Knowing financing strategies can help win more seller business too. How to win more listings with lending strategies. Yeah, so I just put out an email recently about how to sell like a builder. So as a as a real estate agent, you can actually position your listings with 2-1 buy downs and say, hey, the seller is willing to give a credit to cover a 2-1 buy down or 1-0 buy down, which makes it more desirable for buyers to want to come in and maybe make an offer because they know they're going to get a lower rate, right? This is what builders do all the time. Knowing financing strategies can help win more sellers' business too. So this is great, again, for your listing appointments when you're talking with sellers and saying, hey, there's a great strategy out there that's helping buyers, actually pull the trigger. We may want to consider marketing this financing strategy on our listing so that we can attract as many people as we can and get the highest amount of offers at highest price, right? Send your highest and best offer. That's what I see a lot of times listing agents say to buyer's agents. So those are all great strategies that you can use for buyers and sellers. Suitable loan strategies for sellers. This is great for government-backed loans. If somebody has a government-backed loan, they're selling their home, they can market the assumable loan, which does require the new buyer to be approved by that current servicer's or that current seller's mortgage company. So me as a lender, we're not going to be doing much on an assumable loan. It's going to be whatever lender that seller is using or has a mortgage with, right? It's only available for government-backed loans, so FHA, VA, USDA. And it seems like a great option for a lot of buyers because they're like, wow, I can get a 3% rate. But, if a seller bought their house for $400,000 and now it's worth $500,000, the new buyer is going to have to bridge the gap. They're going to have to come in with that $100,000, the equity that the seller has made, to come up and give them their equity and take over the loan. So it's not always the best option or best way to get into a home because of that alone. So keep that in mind with assumable loans. Can my seller offer a rate buy down, a secret weapon for listings? Yeah, they can. We just talked about that. So seller paid rate buy downs to attract more buyers. So if you're offering credits as a seller to help buy that rate down, you can either do permanently or temporarily. Use creative financing to sell hard to move listings. So bridge loan, leasebacks, and owner financing as listing strategies. So owner financing, that's not something that I'm going to deal with. Leasebacks, this is something that is great if a seller needs to stay in their place, sell their home to be able to buy a new place. They don't want to do a bridge loan. They can, sell their home to the new buyer, or the buyer could buy the home with a lease back, right? So the seller needs that home sold, but they don't have a new home yet. So they're going to be leasing out from the new buyer a month or 2 months, whatever it is, whatever you guys decide. But that's a great way, again, for your sellers to be able to get buyers to buy their house so they don't have to have a contingent offer. They can use those funds now for the new purchase. And for buyers, obviously it's a conversation saying, hey, look, this seller has this home available for you to buy, but they need to live in it for a month after you close. If the buyer is okay with it, maybe their lease isn't up. It's a great way to fast track, your buyers and say, hey, look, great. Well, we could buy this house. You still have your lease for one more month, so live in it for one more month. The seller needs at least 1 month to find a new place. Win-win for everybody, right? In bridge loans, this is great for sellers if they have equity in their current home. They don't want to make a contingent offer on the new place. You basically will connect your seller with a lender who has the ability to do bridge loans and will take equity from their current primary residence, use that for the down payment on the new purchase. And then once they make that purchase, the departing residence then gets sold, that bridge loan is paid off. Okay? So mastering the home loan process to build credibility. So when agents understand the loan process, they become a trusted advisor instead of just a middleman. So you want to be a one-stop shop with your buyers and sellers. At least just having the bare minimum knowledge when it comes to the process of getting a home loan is essential, in my opinion. You know, talking about the rate options to buy it down, talking about the down payment options, the type of loan products available. Those are all things that, you know, you as a real estate agent should know, because you're in contact with your lender who's explaining this to you. You're watching stuff like this. So, you know, becoming that trusted advisor is, I think, the pinnacle of where you want to be when you're working with your clients, not just a middleman, right? The loan timeline from pre-approval to closing. So, like I said, we can close loans as quick as 21 days, if not sooner. But initially, the conversation gets started with a lender, right? They're going to get that pre-qualification call. The lender's then going to send a loan application for that buyer to complete. Once that's completed, we're going to collect documents. We're going to pre-approve the buyer. Once the buyer is pre-approved, you go out shopping. You have that golden ticket, the pre-approval letter. You make an offer. You get under contract. Once you're under contract, again, that buyer is going to give the earnest money deposit to escrow. Then that's when we, as the lender, start the processing of their loan. And that means the processor that I work with is going to reach out to the buyer, collect any documents that are outstanding before we send it into the underwriter. The underwriter then is going to take a look at those documents with a fine-tooth comb, look through the loan application, and generate a needs list. So a needs list basically means that the underwriter goes, okay, loan officer, Mr. Buyer, you look great. We're going to approve this loan with conditions. So a lot of times you'll see text messages and emails coming out from me going, our loan is approved with conditions and underwriting. So underwriter has looked at everything. This loan is approved so long as we get the appraisal, so long as we get the insurance documents, so long as we get an updated pay stub to make sure that the income is dialed in and accurate. So once you get approved with underwriting, it's the best feeling, because now you know exactly what you need to give the underwriter to get the loan cleared to close. So once you get all those documents to underwriter, the underwriter looks at them, clears them, gives us the clear to close. Hallelujah. Now we move to generating the final doc. So we send everything into title. They do their thing. They generate the documents to be able to record with the county. Closing date comes around, sign. The buyer is going to sign their documents. Sometimes we fund that same day. Sometimes it's a day later. But once the documents are signed, once the loan is funded, then the county is going to record. Title is going to record with county. Once the recording is done with county, then your buyer gets the keys. That's when you go give your client appreciation gifts, whatnot. So that is the timeline, approval to closing. How underwriters look at loans, why it matters. Again, this is what I just talked about. They're going to go over everything with a fine-tooth comb to make sure that our loan is going to be sellable to the secondary market. Why did my buyer's loan get denied? A lot of reasons. This comes up maybe because the original lender did not look at the type of income that this person who's applying for a loan is making. So maybe they only have 1 year work history. Maybe they only have 6 months on their new business. Maybe they bought a new car and the DTI is out of whack. Maybe they didn't do something right, and then it pops up in underwriting. Underwriter's like, whoa, we can't do this loan because of this. Well, that's because you had a bad loan officer looking through the initial pre-approval and saying that they were approved when they actually weren't. So you want to make sure you work with a good lender to ensure that it's not going to get denied at underwriting. Module 9, the agent-lender partnerships playbook. So as a loan officer, I partner with multiple real estate agents and position myself as a partner to the real estate agent. I do that because a buyer doesn't need 40 different people telling them what to do, because they're not only getting advice from their mom and dad and their uncle and aunt. Now, if you send them to 3 different lenders, they're getting advice from 3 different lenders, and 3 different lenders can be offering them different loan products, telling them incorrect information, especially if you have a bad loan officer who's not looking at their pre-approval and saying that they're approved when they're not. they're going to get confused and going, well, this lender told me that I was approved and this one said I'm denied, so I don't know what to do. It's going to just take up a lot of time and potentially kill the deal, because they're going to feel like they're being scrutinized when they don't need to be scrutinized, or they're going to feel like they're not getting the proper information, which is going to make you look bad, right? Because you sending your business to a particular lender, that's an extension of your business. That is your brand that you're putting out there. So you better bet that, you know, if they have a bad experience with the lender, they're going to come back and blame it on you too, because you connected that buyer with that lender. So keep that in mind when you're out there, you know, telling them, hey, I have 3 different loan lenders, loan options for you, or loan officers. Go talk to all of them, because you're going to be able to shop rates. Yeah, you might be able to get a better rate by having that buyer shop rates, but you might not. You might get a horrible experience for that buyer, and it ruins the deal altogether for you. And maybe that lender has a great real estate agent who's offering 20% commission towards their closing costs. Who do you think they're going to use? You think they're going to use you? Or do you think they're going to use the lender's agent who's offering that commission because they have some sort of, you know, partnership, right? So keep that in mind. Be in tight relationship with your lender. That way you don't lose deals. How to use lenders as a selling tool. You know, again, this is key. As a mortgage lender, when I get a new client who's unrepresented, I make sure right away to connect them with the real estate agent, because I know the real estate agent is the extension of my sale. I can only go so far in my business before the loan closes. I make sure that when I get somebody on the phone and they don't have a real estate agent, I connect them right away to a real estate agent. I say, hey, look, you're looking in this area. I have a great real estate agent in your area who's not only going to help you, you know, find the right home for you, but they're going to go to bat when it comes to negotiating your closing costs and making sure you get this home and making sure everything that you want is a reality. You know, so we're going to be walking together alongside you, working together and figuring out what price point makes sense to make an offer so that you match your payment goals. Because, you know, as a real estate agent, you may be in a situation where you're competitive, and if you say, hey, we're going to offer more than the asking price or list price, and the buyer's like, ooh, I don't know if I want to do that, it just seems like it's going to be a higher payment, you need to make sure that you have a conversation with your lender and say, hey, we may go up to $550. Can you call the buyer and say, and tell them what that payment actually looks like? So that way they're comfortable when you come up to them and say, hey, I think we can win this house going at $550, right? So keep that at the top of your mind. Working with your lender as a partner is huge, because we do work together consistently throughout the close of the loan, and even before the buyer makes an offer. When to loop in your lender, when not to. So you want to loop in your lender as soon as they start asking buying questions. You know, what I need to do to get pre-approved? How much is this going to be on a monthly basis? You know, all those questions that they're asking that you obviously don't have answers to, you want to loop them in if they're ready and willing. A lot of people are willing, but they're not prepared. You know, so if somebody is just like, yeah, I have a 500 credit score, I mean, I don't have any money saved, just kind of losing right now, I just want to go see some homes. Those are window shoppers. You probably don't want to connect with your lender right off the bat. But if they are serious and you have some intuition around it and you go, all right, I think you need to start talking to a lender so you can actually get some numbers and a pre-approval in your hand, that's when you want to call your lender, do a 3-way text, do a 3-way email, whatever, connect them and get that conversation going, and making sure your lender is in communication back to you, letting you know where they're at in the process, right? Because you don't want to be sending leads to lenders and never hearing back from that lender again about that lead, right? So best practices for keeping deals moving efficiently. You know, I'd say depending on the communication style, what they prefer, you know, 3-way text or an email, that's what I prefer. Getting people in contact with your lender is essential, but also letting them know that, hey, you want to do an application, you want to get pre-approved with the lender that I send you. That way we can keep this train rolling and making sure that excitement stays high. Because the excitement level, when they go see a house at an open house, they're excited, they want to buy the house. You don't want to be waiting 2-3 weeks to get them to your lender, or even a week to get them to your lender, because they may lose interest, they may sign a new lease. A lot of things can happen in a week's time, even 2 days' time. So, keep that moving efficiently for yourself and the buyer. Co-marketing lead generation strategies. So I do a lot of home buyer classes. I do virtual and in person. So these are things that lenders can do with you. You can also do state classes. So Washington State Housing Finance Commission classes are a great one, where Washington State will actually promote the classes on your behalf, and then you go and do it virtually or in person. You are in contact with new buyers who are looking and seeking for down payment assistance. So those are all great lead generation strategies to partner with lenders on to generate leads. You can use social media. You can do things on social media together and leverage each other's social media accounts to get more followers, get more eyeballs, more viewership, and have things available to your buyers so that they can easily reach you. Because you're going to be searched, you're going to be researched by these buyers when they are interested in potentially working with you. They're going to Google your name. Make sure you have a profile picture up there. Maybe make sure you have a Google business page. Make sure your websites and your social media pages all match each other. Make sure people can contact you. Those are all things that you, as a professional in the real estate business, need to have if you want this business to grow for yourself. So, future-proofing your real estate business, Module 10. The market is always changing. Agents who stay ahead on financing trends will stand out. So, financing trends today, because rates are higher, those are essential to really wrap your head around and start marketing to your buyers and to your network on, because we've been talking about rates coming down for the last couple of years. They've stayed elevated. They may stay elevated for the next 6 to 12 months. So figuring out ways that you can make these buyers pull the trigger is key. As a professional salesperson, which is what you are, you have to make it make sense to your buyers by explaining these things and using data to back up what you're saying. Saying dating the rate or buy the house dating the rate sounds sexy, sounds good. It's a good sound bite, but sharing, the past 10 decades of how homes have appreciated over the past 10 decades, and only or maybe 3 out of the 10 years, prices have been down. Oh, by the way, you can tell them, you're not going to buy this house and move out in a year, are you? You're planning on buying this house and living in it for the next 4 years, right? So you would expect, even if we do have a housing crash, you're going to have the ability to still make your mortgage payment, hopefully. You're still going to be able to build equity outside of that housing crash. If prices go down, then just stay in the house. Don't stay put. You're not going to sell it because you're not going to only just live in it for a year. You're going to live in it for the next 4 to 5 to 7 years. Just stay in the house and you'll be fine. That's what happened the last 4 years ago, and we had that housing dip. If people would just stay in their house, they made out like bandits, right? So using data, making sure you know the loan products, loan features that you can leverage in this market is key. So how to stay atop of mortgage rates. So I go to, I go to mortgagenewsdaily.com. Mortgage News Daily is a great place to go check out average 30-year fixed mortgage rates, average FHA rates. You can go on my website all the way at the bottom. There is a widget directly from the site onto my website. So you can go there and check out what the rates are looking like. But again, depending on people's situations and depending on the type of lender you're working with, they a lot of times can get lower rates than what the averages are. So don't just say, oh, rates are 7% right now. Just say something along the lines of, yeah, I know the average is 30-year fix is 7%, but my broker actually has access to hundreds of lenders. He can do the shopping for you and get you the best possible rate for you without coming out of pocket for a rate buy down. Stuff like that is going to perk their ears up and go, whoo, hell yeah, I want to go talk to that broker because I want a better rate and not have to pay for it. Talk about alternative financing. So I just spoke with a client today. She can't get a loan with a different lender because they don't know how to do the loan or they don't have the type of loan product. Talk about alternative ways of financing homes. So as a real estate agent, you want multiple options for your buyers who may not fit in the conventional box. Bank statement loans are going to be great for business owners. DSCR loans, which stands for debt service coverage ratio, that's going to be great for investors. So having different unique niche products at your fingertips and knowing the people that you can connect your buyers to is not only going to help that buyer, but it's going to increase your book of business because now you have the expertise to talk about these different types of loan products. So adapting to sales, preparing for a shift in the market, adapting sales strategies when rates or inventory changes. We already talked about this. You're not going to want to be asking for a bunch of seller credits in a hot buyer's market or in a hot seller's market. You may want to be asking for seller concessions now in a buyer's market, or depending on the property, figuring that out, working with your broker, figuring out what is the best strategy for your buyers. That's key. So final thoughts, by understanding the financial side of things of real estate, agents can serve their clients better. That's really what it comes down to. You want to be able to win more deals and build long-term success. And, doing these things half-ass, excuse my French, and explaining these things half-ass, that's just the way I'm going to put it, to your buyers is really going to hurt you in the long run. Because they're going to look to you as just somebody who's willy-nilly about their business. They're not going to look to you as the professional, as the expert in the business. So getting really dialed in on these things, working with your lender, who that is, whether it's me or somebody else, getting dialed in on these loan programs, the process of getting a mortgage, and being able to answer the questions confidently is really going to help build your business in 2025 and beyond. So let's go. Let's get some more deals this year. I know it's tough out there, but there's deals happening every single day. And one of the things I'll leave you with is, get more exposure. Get more people to see you before they can know, like, and trust you. Because that's really what we're in the business of. We're in the people business. We're in the people business. And to be part of people's life events, like buying a house, you have to be part of their life. So whatever ways that you can build more relationships with people, that's what you should be focusing on, because more relationships, more conversations equals more opportunities equals more deals. So I'm going to leave it there. Hope this was helpful. Share this with somebody that may be struggling to learn about how this all works, somebody who's looking to build their business. Hope this was again helpful for you, and look forward to seeing you and talking to you in the future. Take care. Bye.